Equity, mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity Mates, episode 8.
Here we are. Back again. Really excited for this episode. We've got Paul Bennetts, the CEO of Spaceship, on as our second interview for expert investors.
Yep. Paul Bennett, I'm sure you would have seen his company advertising all over Facebook. It's called Spaceship. It's a super fund, and they've been really getting after the Facebook ads recently.
So, kicking it off, as always, we've got some news for you guys, and then we'll jump into the interview. So, first news cab off the rank.
First news bus off the rank, you could say.
Yeah, nice. What do you got for us, Ren?
Yeah. So it's about Borussia Dortmund. Now, for those of you who don't know, they're probably the second biggest soccer team in Germany after Bayern Munich, and they're actually publicly traded on the German stock exchange.
Very interesting. I didn't know that soccer teams were publicly traded.
Yeah, neither did I. Apparently, even the Brisbane Broncos in the rugby league are traded on the ASX.
Wow.
So if you're a big Broncos fan and you love your team, you can own your team as well. I don't think you make much money off them, but
yeah, I just don't understand it. Very interesting.
Yeah, but the difference is, so Brisbane Broncos, you might not make a lot of money, but these big European football clubs, they do quite well for themselves. So, I mean, I'm sure most of their owners aren't in it for the money, but there's a bit more financial incentive over in Europe.
So what do the shareholders have voting rights for, I wonder, or do they at all? Like, what do they vote for in a soccer team?
I assume it would be the same. They could appoint the board appoints a CEO, and the CEO is the head of the soccer team. So they decide who the coach is, they decide how much the manager can spend. I guess think of it like a company, but rather than, selling computers or selling cans of baked beans, their company's goal is to win the Champions League.
So
and
strange.
They make a lot of money doing it. Yeah. There's a lot of money in it. Like sports these days, multi-billion-dollar business with, the TV rights deals and stuff like that. So I haven't looked into it much at all, but it could be a good investment if people are interested.
Anyway, sorry, keep going.
Yeah. One investor had a different idea. And what they did was they bought a bunch of put options. And what that is essentially it's a way to bet against a company's share price. So if you buy put options in Borussia Dortmund, you're basically you stand to make money if the share price falls. And so what this investor did was he bought 15,000 put options in Dortmund and stood to make €4 million on the fall of the share price.
Okay.
Then what he did was he planted a bomb under Borussia Dortmund's bus, and it detonated and it injured one of their players. Luckily, no one was killed. But this guy has just been arrested and he's been charged with attempted murder and a bunch of other offences. And it's all come out that, the German police are alleging that the reason he did it was to try and make some money.
Unbelievable story. It certainly doesn't paint investors in a good light.
You always hear about, insider trading and stuff like that.
I mean, you hear of unethical behaviour, and this is just taking it to the next level.
Yeah, it is. And look, it would be naive to think this is the only person that's trying to sabotage a company to try and make money.
Yeah.
But he's definitely one of the more high-profile ones, given it's a huge soccer team.
Unbelievable. But did the share price do anything significant? Do we know?
It fell a little bit on the bombing, but I mean, at the end of the day, it didn't really affect their share price because it didn't really affect their position as a company, their position in the market, the players they have, the coach they have, their position in like German football. That's the reason that they're valued at what they are.
Yeah.
Not because of their buses.
Well, moving on then, someone who's definitely making their money in a legitimate manner is Jeff Bezos, CEO of Amazon.
A bit of a hero of both of ours.
Yeah. You've probably seen in the news lately there's been a lot of chat of Jeff bringing Amazon to Australia, but there hasn't been any true confirmation from Jeff about this. But there was an article recently that confirmed that they were looking at a huge warehouse for their distribution, which is a sign that they're definitely on their way.
Do we know where it is yet?
definitely out in Eastern Creek area, they shown interest in a massive warehouse. I think they were talking the size of 5 MCGs.
Yeah, I heard that stat as well. That's pretty big.
Which is massive.
Means the Swans could lose 5 games at once.
Certainly good news for consumers. Amazon's going to come and change the retail landscape in Australia. It's also good news for small to medium-sized businesses as well, because Amazon own a fantastic platform that allow businesses to distribute and sell their products through Amazon without having to worry about the distribution and storage of the products themselves. So
yeah. Now, just to give an idea of just how big a giant killers Amazon are, I've got a bit of a list going of companies, big American companies, the established big names that had been there for, decades that Amazon have destroyed.
Yeah.
So we've got Borders, their second biggest bookseller that just doesn't exist anymore.
Gone.
Barnes and Noble on life support. Won't last much longer.
Gone.
So they're the 2 biggest booksellers pre-Amazon that are just not really there anymore. Then we've got in sort of electronics, Radio Shack has gone bankrupt twice.
Gone.
In like clothing and apparel, JC Penney's, Macy's, Sears are all really struggling or have buckled.
Destroyed.
Walmart used to be the biggest retailer in the world, not anymore, and they're competing hard to keep their market share against Amazon. So these are like all companies that we've heard of in Australia and that were sort of fixtures in American life for decades and decades.
Yeah.
And yet Amazon has just crushed them all.
Absolutely crushed them. And I read an interesting article at the start of the week that highlighted one of the reasons that Jeff is able to do this is due to his relentless focus on the customer.
Yeah.
He has a very strong focus on ensuring that every single thing that they do, from the distribution all the way through the customer service, is in the customer's absolute best interest. And that's why in America now they're becoming the number one go-to, because they know that they'll get their product on time, probably faster than most other places that they would buy it from. They get it, within, in some instances, within hours of ordering. And then there was an example given where a customer jumped online and had an issue with her Kindle, which is a product that you can buy on Amazon. And she said that within 15 minutes of lodging her claim for help online, she got a call from a customer help center from Amazon. They weren't able to help her with her query, and so they said someone would call her from the US within 5 minutes, and that happened, and they resolved the issue with the Kindle within half an hour, which I thought was pretty amazing.
Yeah, that's the customer service you dream of.
Yeah, exactly. And it's what's going to kill places like Harvey Norman and Myer and potentially even Bunnings is going to have someone now running them, giving a run for their money.
Yeah, well, the interesting thing is that hardware hasn't, obviously Amazon have some market share, but they haven't been giant killers in the same way that they have in a lot of these other spaces. So it will be interesting to see. The interesting thing about Amazon though is that they're very adaptable to local markets, and they get really good teams in place to compete in the market that they're competing in. So the strategy in America hasn't just been replicated, over and over again. The one that I'm really interested in is India is a really big battleground for Amazon at the moment, because there's quite an established e-commerce platform there called Flipkart.
Yep.
Indian owned, Indian operated. So obviously very acclimatized to the local conditions. And Amazon is investing billions in India at the moment to take on Flipkart, and it is really an interesting battle to see. And it's interesting to see just these 2 giants slugging it out, but also to see how well Amazon adapts to local environments.
Yeah, very much so.
It's a warning shot for any retail giant in Australia.
And third news item, quite topical, is to do with superannuation and also what everyone's talking about, the housing crisis or the housing bubble that we're seeing in Sydney and Melbourne at the moment. Certainly not in other areas of Australia, but particularly Sydney and Melbourne. And there's been a lot of debate at the moment within government as the budget is coming out soon in May as to what measures they can put in place to make housing more affordable or accessible for our generation in particular, as people are finding that they're just getting squeezed out of the market and aren't finding any opportunity to buy with anything reasonable or affordable. So one of the suggestions that has been under debate for a while now is having super available to the younger generation. So that would mean withdrawing what is available in your super account at the moment and in some way using that to go towards a house, be it in the form of a deposit or whatever it may be. That would be a measure of allowing us to access housing a bit easier than if we were to try and save the deposit ourselves. However, there's been a lot of debate about it, and there's overwhelming support for this not to go through, particularly from Malcolm Turnbull. However, it's interesting that the Treasurer, Scott Morrison, is in favour of this policy. So the reasons that it would be a bad idea is two reasons. One is a revenue loss to the budget over years, which would be billions of dollars lost in revenue that comes from tax earnings on assets that are within your super fund. But the major concern is that the impact down the track. If we withdraw money from our super now, empty the accounts, put it into a house, then it doesn't solve the problem of having some sort of capital at when it comes to our retirement. And it's just going to put a whole lot more pressure on ourselves, really, to support support measures such as the pension. And there's going to be an increased number of people that are relying on the aged pension later on down the track if this policy does go through and people do start using their super for housing, because it speaks to the whole idea of compound interest. Having money in here now is going to be worth a lot more down the track than potentially if you were to use it on a house. But it's more to do with the fact that you're not going to be generating any income or revenue from an owner-occupied house, as opposed to having your super in shares or in a property investment where you will be generating income and not so reliant on support measures such as the pension and that sort of stuff. So that's the major concern.
It's probably worth just quickly explaining the beauty of compounding. As we go into this conversation about superannuation, Warren Buffett calls it the eighth wonder of the world, because it really is the reason why you should start investing young. So hypothetically, if I had $100 and I got $100 in shares and I got 5% dividend on that, I'd be getting a $5 dividend. But then if I reinvested that, and so I had $105 in shares, then and I got another 5% dividend the year later, I would get $5.25 in dividends. And so then if you reinvest that, then your dividend grows. And if you reinvest that, it grows and it grows and it grows. And it grows at an exponential rate. And that's why, if you get in the market young, especially if you get in it while you're in your 20s, and you hold a lot of the money that you've got in the market, or at least you can buy and sell different shares, but you don't take it out of the market, that's where you really start to make a lot of wealth. And that's where you can see Warren Buffett's wealth has exponentially grown, and especially as he's got to his very late years, now he's the richest man in the world, or the second richest man in the world, because of this just beauty of compounding. Because the more you have in the market, the more you're going to get, and then you put that back in the market, and then it just grows and grows and grows. Yeah. And that's why superannuation is so important when you're young. And I guess that's as good as any point to introduce our interview with the CEO of a superannuation fund.
Yeah, great segue there, Ren. So that takes us perfectly into Paul, who, as we said at the start of the episode, is the CEO of Spaceship, which is a superannuation fund that is trying to disrupt the way that we think about superannuation and the way that we invest in superannuation. He feels that there is a heavy reliance on superannuation investing in the big four banks and miners and that sort of stuff, Telstra, and it's not really the direction that the world is going in terms of...
We're a very insular nation.
Yeah.
As Australian investors, yeah.
But if you look at some of the world's biggest companies at the moment, and where a lot of the world is putting their money, it's in technology and tech companies. So Spaceship has a focus on investing superannuation into tech stocks. Not entirely, but a proportion of your portfolio would be invested in tech stocks. So something new on the market, something different, and something worth definitely having a look at. Paul himself is a very accomplished man. He's ex-Goldman Sachs and then...
Worked at Airtree Venture Capital for a while, Australia's biggest venture capital firm.
Yeah, so he's had some experience in VC and is now working with, I think they said, a team of 9 to start getting Spaceship
very
off
small
the ground.
team.
Yeah,
very surprising. Yeah.
So,
if you want to check them out, spaceship.com.au or scroll down your Facebook news feed. I'm sure you'll see an ad by them. Yeah, enjoy the interview. So, Paul, do you want to start by telling us a bit about yourself and about Spaceship?
So Spaceship is a new superannuation fund for folks with long time horizons. So generally we're focusing on the sort of 20 to 35-year-old bracket. We started Spaceship because generally, and this is my personal opinion, if you are a young person who is saving money compulsorily through super and you were to actually try and make a product decision within superannuation, it's actually really hard to do. Now, you guys have... through the podcast that you have is obviously investing backgrounds or finance backgrounds. So anyone with an investment finance background loves reading through a PDS or loves thinking about asset allocation. But for most young people, they find that a huge hurdle to be able to enter into these products and make a decision around them. So, historically, most people have been disengaged from their super because it is hard to understand and you generally don't hear from your superannuation fund. Some funds only send you once a year annual statement and that's all you kind of get. So we wanted to start Spaceship to firstly help people with their superannuation and think through from the ground up, from first principles. If you were to start a super fund with a blank sheet of paper, what would that look like? Yeah. And instead of trying to be all things to all folks, we just want to focus on our generation, which is, my generation and your guys' generation, and build something that's very, very helpful for them. So that's the kind of ethos around.
Yeah. So from that, what makes Spaceship different? Like, how do you target yourselves at that millennial generation?
Our generation is the generation that you'd call the internet generation. So we've seen technology completely spread itself through society. We've watched the 5 most valuable companies in the world become technology companies. Locally we've seen companies like Atlassian grow bigger than Qantas. We use it every day. We're sitting here on iPhones. We're using Snapchat. We're going home to Netflix. On the weekends we're in Ubers, and when we go away we're usually in an Airbnb. So it's not a big leap for people to think, well, if I'm constructing a portfolio that's going to be around for the next 30 years, shouldn't it kind of be aligned to where the world is going and not so much where the world is today, right? And if you look at your superannuation, certainly for my own personal superannuation, when I looked at it, I saw that it had like a 40-50% allocation to Australian stocks, and if you look at Australia's got 3% of the world equities, so the other type of customer we get is the index type customer who's like, hey, I just want to own the index. Well, the Aussie index isn't really an index. It's 36% financials, it's 17% commodities, and it's 15% property. So it's not even a diversified market. And if you really want to just own the index, and that's an appropriate strategy for some people, shouldn't it be the world index? Why is it the Australian index or the US index or whatever? I mean, if you really want the top companies in the market basket, then you should own things called the MSCI World Index, right? But even that's hard to do. Do you know what I mean? So we're trying to differentiate ourselves not only through portfolio construction, but also just making the whole experience, to have an ease of use. Yeah? So anyone with any type of background can approach these products and understand the importance of the financial asset they're building. And then have all the information they need to make an appropriate decision. Yeah.
At launch, is there going to be just one product offering, or is there going to be a number that investors are going to be able to choose between depending on their associated risk level?
So when you start with 0 funds under management, you're very limited in what you can do, right? An example of that is it's hard to have life insurance. It's, your fees are kind of constructed based on them not wanting you to go out of business and all sort of stuff, yeah? So you'll see all those changes come through. And what we have to be careful of is you can't actually... A customer can't buy a product based on what the product's going to become. They can only buy on what it is today. Do you know what I mean? So you've got to be careful on how you market where the product is going. But it's obvious that we want our fees to come down. We want to add life insurance. We only have one investment option now. You're going to see that expand over time. But we can't overly, stand on the top of a mountain and talk about that sort of stuff because there's a fine line on from a compliance standpoint. But we've been so fortunate that an early group of customers have started coming on board since January when we got regulatory approval to be a super fund. We've been onboarding them since early to mid-January. We've almost got $100 million worth of fund now under management. And what we're doing now is we're putting through a set of product changes, which I kind of spoke to then. So we're actually kind of just, hey, we don't want to grow too quickly. We've got enough fund now that we can do the things we want to do with product, and we're making those changes. So, and that takes a bit of time because we're using an external trustee compliance department, and they take their time because they should. These sorts of things. But we're super excited. We're hoping to get that all done in Q2 and really kind of grow market share from there. So.
Awesome. Are you able to give us an indication of what the split is going to be in terms of investing in tech and then how you'll diversify?
Yeah. So our current tech core. So right now, if you go into the portfolio, you'll see there's a tech core of 35%, where it's all technology companies, and then there's passive diversification around it. What we haven't built out, which is the thing that you need funds under management for, is alternative assets. All super funds answer alternative assets with toll roads and property and private equity funds and stuff. We think there should be direct ownership in large technology companies.
Okay.
The Ubers of the world, the Airbnbs, all that sort of stuff. We're going through that process. We're excited about that process. I think when you have one investment option, rightly so, it's hard to kind of be too aggressive in how much tech you own. Do you know what I mean? When you have multiple investment options, some folks who are like, I'm 20 years old, I've got $2,000 worth of super, I'm totally happy it being 100% in tech. I don't know whether we'll get to that level, but to show an extreme end of the spectrum. And then because you have multiple investment options, folks can kind of align themselves to their risk appetite in that class. And then all the way down to the other end of the spectrum, we're trying to do something around a passive portfolio. So those folks who just want to own the market, and we want to price that in line with the rest of the industry and all that sort of stuff. So we're excited about all that sort of things, but we can't say exact numbers on any of that until it's done. So.
The reason I ask, because leading up to this, when we were talking to some mates, questions were thrown like, it's a great opportunity to get involved in the tech side, but then what happens if you're so heavily in tech? What happens if that industry goes belly?
The biggest misconception is that there's this whole short-termism that's moved into the markets over the last 50 years, where if you look at the average turnover of a stock in the 60s, it was actually 7 years. So that was the average hold period, 7 years, right? And you go to the New York Stock Exchange website, you can download all the data and you can see that chart over time. If you look at it today, it's 7 months. So it's gone from 7 years to 7 months. So if you talk to anyone today and you say, hey, I'm going to hold something for 8 months, they're like, dude, you're a long-term investor, right?
Do you reckon a lot of that's because of bots, though?
Look, it's going to be the trading activities and the quant strategies have been around for a very long time. Renaissance Group has been around since the 70s, I believe. So there's always been quantitative type trading. I think they've become more and more sophisticated. But I think more generally, if you look at the way the addition of Bloomberg, the addition of CNBC, all these kind of media, and the opportunity to not buy a stock through a broker, but actually have to be able to buy it through a online discount trading platform, everything's kind of built to move towards short-termism. The problem with that for a superannuation investor is that you can't sell out in 10 years. You actually have to keep your money in a box until you're 65, right? So the question becomes, if you're not going to leave the financial markets for the next 30 years and you're starting with an average balance of, say, $40,000 today, next year you're going to add another $8,000. Next year, the year after that, and the year after that, and the year after that, you're every year allocating money to the markets. And the question becomes more not what's happening through a trading cycle, a business cycle, not so much what, whether you can get alpha in a boom and a bust and all sorts of stuff. It's more, I need a diversified portfolio of assets that I can continue to allocate over the long term. So then it feels like more like a kind of Warren Buffett approach, where it's like, hey, I want to select 100 companies that I think are highly differentiated, highly defensible, and I may be paying too much in a bull market, but I know there's going to be a downturn, and I'm going to be continuing to allocate to these names through the cycle. So if you look at if you look at long-term investing, there's really only two things that determine your return. It's your entry and exit trading multiple, so the valuation multiple. And give you an example of that. If you bought Amazon at the height of the dot-com bubble, if you were that stupid guy, you pay 23 times revenue, right? 23 times revenue. today, Amazon trades at 2 times revenue, right? Now, it's hugely hard to make a return when it's gone from 23 times revenue down to 2 times revenue, right? But if you're a long-term investor, you're actually aligning yourself to the underlying economic engine of that business. So Amazon, even though its trading multiple has shrunk, the economic engine has continued to grow every single year. So in 1999, it had $1 billion of revenue. Now it's got something like $130 billion worth of revenue, right? So if you were the guy who bought Amazon on its most expensive day in 1999, you're still up 10 times today. And that's because it's what economic engine should you be aligned to. And some people will say to me, well, hang on, Paul, do you know there were so many .com companies, like how would I have known to buy Amazon? Well, how many companies have $1 billion worth of revenue? Like that's a company that is on only a few people's radars because it's so large. So I don't know what your question was, but you should really kind of, superannuation, people have to realize how long-term this is. And it's not about trying to trade through a cycle or anything. It's just really, what are the 100 companies I'm engaged with and want to own over the next decade? Do you know what I mean?
Yeah. So I guess maybe we'll turn the focus to you a little bit and ask about like your personal investing journey and how you got to where you are today.
Totally.
So just to start very generally, like what got you interested in investing to start with?
So I got investing. So I always wanted to run my own business, and and I was also very interested in computers at the same time. This was back. So I went through university in 1999 to sort of 2002. I did a Bachelor of Business. And I was working at a computer store where you actually could upgrade a computer, you could repair a computer, you could pull out a graphics card and put a new graphics card in. Yeah. And that was my part-time job. And in my last year of university, I was like, I want to do this for myself because I see where they're getting the parts from out of Brisbane and all sorts of things. I started my own computer store with kind of 10 grand of what I had at the time. It was hugely profitable for a 20-year-old. Like, not much money today, but at the time I was like, oh my god, I can actually, spend $100 on Friday night and go crazy. So, the store was pretty much profitable from day one. And then I started thinking, what do I do with this? I'm getting $1,000 profit a week from this thing or whatever it was. What should I do? Should I invest that? So based on a small business going well for me, I had to start thinking about learning how to invest. And I stumbled across a book on Warren Buffett, and everything to that point really didn't make a lot of sense to me. There was day trading books and there was Campbell chart books and all sorts of stuff. The only thing that really resonated with me as a business owner was here's a guy who invests in businesses as if he's owning the entire business, rather than trying to buy something this quarter and sell it next quarter. He was going to buy Coca-Cola in 1987 and hold it until today. So that's how I kind of got into thinking through how to invest, and it was just such a buzz because I'd see my little retail store and I knew what was wrong with it, right, as far as a competitive standpoint, and then to be able to kind of look at very big industries like UPS versus FedEx and think about UPS's strategy of the driver being an employee versus FedEx being a franchise of the truck driver, and kind of thinking about how does that change the economics of both those businesses and the competitive standpoint and the differentiation and defensibility. And it was just such a fun kind of thing to kind of learn about all those businesses for the first time as a sort of 20-year-old.
Yeah.
So can you then explain what your sort of philosophy of investing is?
Look, I think I've kind of talked to it a little bit already. I think really there's two things that determine investment return: a change in valuation multiple and the growth in underlying economic engine. So if you look at Coca-Cola in the 60s, they weren't selling Coke in that many countries. Based on globalization, they were able to open up more and more markets, right? So that's the economic engine growing over time. What the trading multiple is tell me what the PE multiple of Coca-Cola is going to be next month. Who knows? And if you buy it this month and you need to sell it next month, the only thing that's going to determine your return is a change in that PE multiple. Look at Snapchat when they IPO'd. The first day they were up 44%, the next day they were down 12, and then down 10, and then they zigged and zagged for the first 5 trading days. But what actually changed in the offices of Snapchat during that week to have such a massive change in equity valuation for that business? Nothing. So for me, investing only becomes interesting when it's over the long term, because then it becomes much more about evaluating the differentiation and defensibility of economic engines rather than what the guy across the table is willing to pay for your stock 12 months from now.
So with that Snapchat one, a question we asked on one of our earlier podcasts was, will Snapchat be a Facebook or a Twitter?
Yeah.
in terms of its future success. And given that you're, a tech investor, I guess would be remiss not to ask you what your thoughts on Snapchat are.
Oh, was it? Yeah. Well, I can't exactly remember the numbers, but the way I think about Snapchat is they did $400 million worth of revenue last year, right? Twitter did $2.5 billion worth of revenue last year. Yeah. Facebook is doing $25 or $30 billion worth of revenue, right? If you look at that on a per user basis, Facebook is generating about $15 per user, right? In their North American and more developed markets, they generate $60 per user in a year. So that's what through advertising dollars, at the best success a company can do right now is Facebook, and it's either $15 across developed and developing markets per user, or $60 from a North American and European market, right? Snapchat, on the other end, is generating $2.50 per user, right? And the majority of their users are also in Europe and North America, because they just haven't penetrated other markets. So if you look at the daily active users of Snapchat, I think they've got 158 million daily active users at this point. The investment thesis around that business is really kind of moving from a $2.50 per user of revenue to something closer to Facebook, right? Now, if you look at Twitter hasn't been able to do that. Twitter generates $67 of revenue per user, right? And their growth curve has left them. So they're not growing their customer base any further in their audience size. Whereas Snapchat is at the beginning of, I never say this word correctly, modernization, right? Very beginning of that journey, with only generating $2.50 per user. And if you go on Snapchat, you barely notice advertising, really. And their audience size is still growing very, very quickly. So they're the only two drivers that will really determine whether Snapchat is a Twitter outcome or a Facebook outcome. I think the other interesting thing about Snapchat is that the team there has been so ambitious in product changes. So if you look at the last 4 years of Snapchat, they have really made bold moves to product. Yeah. Now, Twitter within a public markets environment, it's actually harder to make bold product changes, because you've got to go to shareholders 3 months later and say, was that a good idea or a bad idea? Whereas Snapchat's been able to do it in the private markets under, without anyone looking at revenue or DAUs or any stuff like that. So the question becomes, can they as successfully iterate on product and innovate within a public market realm? I think the jury's out on that, but I think it's safe to say you're going to see revenue levels go from $2.50 up to at least Twitter, and then perhaps beyond. If it does, then I got no idea what the market cap of Snapchat is today, but it was IPOing at around 20 or 20 billion. Then at generating 400 million at $2.50, well, you can very easily get up to billions of dollars of revenue by that $2.50 going to 6, 7, or even 15. Yeah. Or keep in mind that Facebook's generating $60 in North America. So where is the natural level for the Snapchat? I don't know.
Yeah, that's a big question. Yeah. So from that, starting investing from the profits from your small business, where has your investment journey taken you? What are some of the things that you've sort of picked up along the way that could help our listeners as they start their investing journeys?
I think the wonderful thing about investing is that you learn so much about business, right? It's just such a wonderful intellectual exercise, and it's not just about business too. It's about where economies are going and how, because the reason the economy is so important is because the government is such a massive actor in the economy, right? So if you're an actor as a business, and you have this gorilla which is the government, then they do kind of impact your business, yeah. So it's fascinating not only to learn about the competitive strategies of businesses and their differentiation and their defensibility, but then also flipping over to the economy and learning about the different types of economies in the world. And there is no really pure capitalist economy at all. They're all even Trump's economy now, it's moving towards more of a dirigism, which is this idea that France after the World War II was more of a directed economy, where the government kind of said we should do this, we should do that, and that's what Trump seems to be moving towards. And it's fascinating to kind of learn about how economic growth has worked under these different levels of control from the government. So for me, investing is more of a answering curiosity about the world than a money making exercise. But the sad thing is, you need like 5 years before you'll learn anything. You know, like you know, as a 20-year-old, you won't learn anything the first 3 months of investing. You'll wake up as a 25-year-old and go, oh, I learned some stuff. You know, but no idea whether you made any money, right? And so I think that the first thing people should do is to move away from I'm gonna get 10 grand, I'm gonna buy this stock and see what happens in the next 12 months. And what they instead should do is go, okay, I've got 10 grand, I'm gonna slowly allocate that into the markets over the next 12 months, and then I'm gonna set up an automatic savings tool to allocate to the markets over the next decade. Yeah. And that's kind of a hint of what we're building at Spaceship, where we don't really see a difference between compulsory savings and investment and discretionary savings and investment. Because lots of our customers, they sit there and go, I love what you're doing over here in super, I love what you're doing with portfolio and how you're helping me learn how to invest and all sort of stuff. I've got this kind of money in a savings account over here, I've got no idea what to do with it. I go to this person's website, I don't understand it. I want to start saving, I want to start building wealth. Are you going to build products over here as well? So we're kind of taking a more holistic approach to people's savings investment. We would love one day to wake up and be the savings button on your phone. Okay. So that's how we think about it.
So does that mean a Spaceship fund will start as well as a superannuation fund in the future?
Totally.
Okay.
Yeah, you should.
Great.
Yeah, totally. And that's what we've got a wonderful team working on all that sort of stuff. And
So for beginners then, when you say you're not going to learn anything in 5 years, what's a way that you would suggest without directly investing in singular companies that you can at least start getting involved in the market without having to worry too much?
well, I think you can buy the index for starters. That's always interesting. I think it's more developing the habits of what makes a good investor, and that's kind of constantly learning about things going on. I think it's totally okay to buy a single company stock, but just know that you're going to own it for the next 5 years, and you should probably average into it as well. Like one of the first stocks I got was Berkshire Hathaway, and I was just like, oh man, this is so cool, and I learned more by owning that than what financial return I've generated from it. Do you know what I mean? Because I was forced to read his annual report every year, and I read the first couple of pages of the 10Q each quarter. I didn't really understand all of it, but over the last decade or so, you build up a kind of a database of knowledge around that business because of it. Do you know what I mean? And so you learn a ton by owning an individual company stock. Just don't bet the farm on it. Do you know what I mean? And if you can, allocate into it over time. So I've bought a number of Berkshire Hathaway shares over time because I've tried to average in at particular points in the business cycle. If you know enough, you should buy an individual company stock. You should kind of go, I think this particular Google is a wonderful company, or whatever it is, without giving stock recommendations. You should do that sort of stuff.
What has been the best investment you've ever made? It can be financial, but it doesn't have to be. Just, in your investment journey, what's the one thing you've really benefited from?
I'd say Berkshire Hathaway for sure.
Yeah.
Just allocating into that over time has been a wonderful thing. And particularly, I remember it dropped down really badly in 2009. And because I had been a long-term investor at the time, I kind of understood, what that meant. I thought, wow, this is great. I was able to, buy more at depressed levels. So it's not easy to understand the differentiation and defensibility of a business in any event. That's hard. And usually the most differentiated and defensible businesses have high valuation multiples. But as long as you can hang in them for a long time, usually the underlying economic engine does its job and it builds out. So,
what do you think will happen to Berkshire once Warren goes?
Well, I think so Berkshire has morphed from this kind of guy picking stocks to an operating business where it has 68 operating businesses underneath them, and the CIO of that business, which is Warren Buffett, has selected businesses based on competitive advantage, and which is really just pricing power, the ability to lift prices over time. So even if he goes, and he will, you've got this wonderful economic engine in those operating businesses, and you have two amazing fund managers who also think like Warren Buffett to do it. Warren Buffett is not the only person who can make good investment decisions. Otherwise, that would be what kind of crazy world would we live in if that was the case. But usually, the problem is more the incentive structures that surround people's investment decisions. So even in private markets, if you look at private equity firms or VC firms or corporate, or corporates, every time investment decision is being made, really unpick the incentives of the person making a decision. Usually, there's a lot stacked against them to do it. I've got friends who are fund managers, and their biggest frustration is having to report on returns every month. The problem with that is that it doesn't matter how long term you want to be, you're always going to be at the behest of someone receiving a report saying you were up or down 1% in that month, and then explain yourself. It's like, well, not much has happened in the last 4 weeks.
We did a bit of research on your background before we came here, and you worked at Airtree, is that
yes.
correct? Yeah.
Yes.
So for our listeners, Airtree is a VC firm, venture
Yes.
capital firm in Australia.
Yes.
How has that experience sort of shaped your view about investing, and especially on the Australian technology scene?
Yeah, look, I think Airtree is probably the best VC firm in Australia at this point. I think it's safe to say they started with a $60 million fund in 2013 when I joined the business, and we raised that capital. And based on that traction, they've now raised a $250 million VC fund. That's the biggest one in Australia. So usually you can't be the biggest fund in Australia unless you know what you're doing. And they continue to building out their team and trying to be more and more helpful to their portfolio companies. So not just having investment professionals, but actually having guys and girls in there that can be helpful to their businesses. So Airtree's done phenomenally well, and from really a standing start in 2013. And that was also a wonderful experience for me because we got to invest in 20 private companies in the first fund, and then work with those founders over time to kind of through the ups and downs of building those businesses from scratch. Everyone wants to be a VC because it's such a cool job, right? Yeah. That's amazing.
Yeah, definitely. So from that experience, what do you think about the Australian technology scene? Do you reckon there's potential there? And
I think there's huge potential there. I think there's actually hundreds of very large technology businesses that people don't even focus on. We've got someone joining from Campaign Monitor very, very shortly. Campaign Monitor is a $1 billion business on Park Street. You wouldn't even notice. You know what I mean? And I wish there was way more coverage within Australia on these wonderful businesses that we have. Sometimes I think the reporting on business and tech in Australia is more sort of pulling people down rather than kind of telling the wonderful stories behind these businesses. I think what's blossoming now is a lot of private capital is moving in and funding these opportunities, which is great. Some of the opportunities are regional, and some are sort of global, which is really exciting. Yeah. I think we still have a long way to go as far as the amount of capital coming into the ecosystem. I talk to VCs outside of the market, and some of them say that we're undercapitalized as far as companies are concerned. And it is hard as a founder. You sort of given $1 million and you sort of like build a business. And it's like, well, that feels like a lot of money, but it's actually really hard to do. By the time you hire some people and stuff, you really only have 12 months or something to kind of do stuff, and 12 months isn't even long enough to write a thesis at a university. So how can you build an economic engine at that point? So, but I think directionally everything's going wonderfully. You just have to give it time. And even we're sitting in Tyra's offices right now, which Andrew Rothwell and the team at Tyra have done a phenomenal job of building a business, and it's just so exciting watching and seeing that business grow in front of us. So.
Yeah. So down the line for Spaceship, would you be looking at doing some sort of VC work and putting some of the super fund into Australian startups?
Yeah, so I think we have to frame it from this is retirement money.
Yeah.
You know what I mean?
Yeah.
So we're probably not. It's probably not the right place for people to be getting 10% of their super and putting it into a startup that's may or may not be around in 2 years from now.
Yeah.
I think what we found over the last 10 years is wonderful technology businesses are starting to take longer and longer to get to the IPO markets, right? So Uber is now over $50 billion valuation. Whereas if you look at when the TripAdvisors of the world, where they IPO'd when they were less than $1 billion, now they're worth over $10 billion. We should really have that wealth creation as much as possible available to retail investors.
Yeah.
And the private markets are usually the sort of arena of wholesale investors, and for good reason, because you want the wholesale investors have more capital where they can lose if things go wrong. So if Uber at $60 billion is probably should be in retail hands already, because it should be a public business. And then the startup with 12 months to potentially live or die is way, way too early. There's somewhere in between there where it makes sense to allocate a small portion of your retirement portfolio too. Now, this isn't new. You know, all super funds, you know, allocate to PE funds or toll roads and property and all that sort of stuff. Our view of the world is we really believe the next $1 billion business is probably not going to be a soft drink business. It's probably going to be a technology business. And if you look at every company on the S&P 500 that was formed after 1970, the majority of those were VC backed.
Yeah.
Right. So they all sort of seem to start in VC land and graduate out. Now, we will do whatever our customers want us to do, as long as we think it's in their best interest. Our customers don't want direct allocation to VC funds, but they want direct allocation to wonderful private technology companies.
Yeah.
So we will have a team in place in Australia. I don't know what we'll call it, but it's Spaceship something. That will be there to find opportunities in private markets to allocate to wonderful private companies such as technology companies. So,
Very interesting.
Yeah.
but everything gets easier if folks believe in us earlier and give us the opportunity to kind of build out these wonderful things we want to do. So, the people who are rolled into Spaceship already, we're just so grateful for them to put their faith in us, because we know we have an incomplete product. We know we have, we want to look back to where we are 12 months from now and just go, oh my God, I can't believe anyone even gave us a chance, because it's really hard, because we're sort of starting there with a small fund. We're in the face of other super funds out there with 10, 20, 30, $50 billion under management.
Also, the psyche of super at this age as well is something that is hard to break, I guess, because for some of our mates, they're not even thinking about it.
Totally.
So getting the message across to them that it's something that could benefit them significantly in the long run.
Totally. We always use the car analogy. We say if you're on $100,000 right now, you're going to spend $9,500 with the fund manager this year, right? And be like, really, am I? And I said, yeah, you are. And if I gave you $9,500 on the table right now, how would you spend that on a car? I said, go buy a car with it, yeah? Well, what would you do? You'd go straight on the internet and you'd be looking at car photos, right? And then you'd be going to car yards on the weekend to try cars. And then you'd be talking to your friends about which cars they like and all this sort of stuff. And you'd probably take 3 months to make a decision. Whereas with super, people default into whoever their employee gave them, and they don't think about it. Exactly. So, and that's really sad. But when we kind of frame it as a car, people are like, holy shit, I'm buying a car this year. I probably should do some work on it.
Yeah.
So,
Well, we know you have to go, so
Yes.
just before you do,
Yes.
do you want to give one last plug to Spaceship, or
Give us a buy recommendation.
What's that?
A buy recommendation.
Well, so from a personal,
Amazon.
so from a financial advice thing, people should do their own work. I'm not a financial advisor or any stuff like that, so I can't give financial advice. Everything I talk about today is really just in the disclaimer of that. And the good thing is about the industry is they really see us as a positive force. We're trying to help people with not so much investing, but with savings. So superannuation is both a savings and an investment product. And I feel like to date, if you look at the product suite that's out there, it's very focused on asset allocations and PDSs and investments, rather than kind of, the question all our customers keep asking us is, hey, I got to save 9.5% of my salary this year. That number is actually going to 12% by law in 2025. If 9.5% is wrong and 12% is right, should I save 12% this year? I mean, just tell me how much I need to save this year. That's the question. And if you're retiring when you're 65, you need some amount of money in a box when you're 65. But no one really knows what number that is, and they don't have the tools to say, hey, I'm on $70,000 now. If I want to be earning $70,000 when I'm 65 and not have to work, then I need $3 million in a bank, whatever it is, some number. And the product suite, the product roadmap that we have is really around making it easy for people to understand what the final number is. And you guys are smart investors, right? Financial guys, where you can kind of go, well, if I assume a 6% market return over the next 30 years, that means I will have a different savings requirement this year than the guy who's more conservative only wants to rely on a 2% portfolio return over the next 30 years. Because the guy who's only relying on a 2% portfolio return has to actually save more this year. But you kind of want it such that your customers have a conscious decision as to what they want to kind of rely on, right, from their investments. So we really want to solve savings for this generation. That's what we're trying to do. So
that's it. Aim high. Just solve savings. All right. Well, Paul Bennetts, thanks so much for taking the time. Check out the website, spaceship.com.au.
Yes.
Yeah, thank you.
Thanks very much, Aaron.
Really appreciate your time.
Thanks, man. Cheers.
Thank you.
Thanks a lot.
Equity mind.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.